Hey there, I'm going to get right to the point. Bitcoin's long-term holders, those who haven't moved their BTC in 155 plus days, have just done something unusual. Their combined supply just dropped to the lowest point we've seen in about 8 months. Over 1.1 million BTC shifted wallets in the last month alone. If you're hearing that for the first time, you might feel a bit of whiplash. LTH supply falling like this usually raises alarms, and it's startling to see. Let's break down what these numbers mean. The chart above from Unchained Analytics shows exactly what we're talking about. Around late November 2025, the purple line representing the percentage of BTC held by long-term holders dipped to roughly 71.92% of total supply. That's the lowest percentage we've seen since way back in April. My gut reaction was also panic. Seeing numbers like that definitely feels intense. But hang on before you reach for the panic button. First off, those headlines might scream capitulation or bearish cycle top, but let's take a breath. Remember, data itself is neutral. It's just telling a story. And that story needs context. In raw terms, long-term holders have decreased their holdings from about 14.8 million BTC in mid-July to around 14.3 million BTC by early December. In other words, roughly 500,000 BTC moved from old hands onto the market in just a few months. And yes, one big chunk of that, approximately 1.1 million BTC, was in a single 30-day stretch around late November. A lot of journalists and analysts jumped on that saying LTH capitulation. But let's not jump the gun. The CryptoQuant on-chain chart above highlights that move. The largest red bar is the massive negative 1.1 million BTC shift on November 26th. Even seeing a bar that big can be jarring. It looks like a market dump, but remember, this is the net change in long-term holdings, not the total traded volume. It's one side of a handoff, not necessarily the end of the party. I'm sensing your concerns. You're probably thinking capitulation means selling at a loss, right? The cycle is done, bear market incoming. That's the narrative being thrown around. The thinking goes, if the long-term, supposedly patient holders are selling big, they must have thrown in the towel, and I get it. On-chain charts can be scary when you don't have the full picture. Indeed, some analysts have framed this as long-term investors capitulating, as if they were forced to sell out of fear of deeper drops. And sure, the price charts aren't bulletproof. Bitcoin did break below its 50-week moving average and even formed a bearish flag before dipping under $92,000. Technical analysts have reasons to be cautious, but before you hit sell, consider an alternate perspective. What if this isn't panic selling at all, but smart money taking profits? Picture this. You've been holding Bitcoin through this bull run and now price is in the mid-90,000s. Wouldn't you feel tempted to secure some gains? History tells us that seasoned investors often sell into strength rather than dump in a crisis. In fact, one analysis noted that long-term holders took advantage of a local correction, around $80,000, to buy more in April 2025 instead of panicking. In other words, they saw a dip as a chance to add, not as a sign of doom. Selling at or near peaks is rational, not necessarily a sign of fear. It's like someone offering you double what you paid for something next week. Why wouldn't you sell at that moment? Many long-term holders have held coins for 5, 10, or even 15 plus years, so their average cost basis is far below today's levels. Taking a portion of profit off the table after a huge rally is simply prudent. It's not capitulation, it's portfolio management. And who's buying those coins they're selling? Likely new entrants, latecomers, or institutions who wanted exposure at higher prices. A supply rotation from one group of hands to another is not a cascade to zero. If experienced hands sell into a rally and new buyers step up, the market capitalization can keep climbing. In fact, selling on strength often sets the stage for the next leg up, since the selling pressure is already out of the way. Think of it like a relay race. One runner, the long-term holder, tags the next runner, new investor, and the race continues. The question is, do we have a runner ready on the other side? So far, it seems the answer is yes. There have been solid bids as Bitcoin touched the $80,000 to $84,000 zone. If price stabilizes there, it suggests demand is soaking up the supply. Here's another way to see it. If someone had offered you a huge profit on your car tomorrow, you might sell it even if you love driving it. That doesn't mean you'll never own cars again, just that you're happy with that trade. Long-term holders are doing something similar, shifting to fiat or alternatives. It might even be smart money strategy, not blind panic. Let's time travel a bit. Flashback to late 2017. Bitcoin was at all-time highs, and many old coins moved. People panicked and yelled capitulation. But then, Bitcoin resumed its surge into early 2018. It turns out long-term holders often take profits around peaks. The same thing happened in 2021. Around the late 2021 cycle, top, LTH supply dipped sharply when retail hype peaked. Analysts at Glassnode pointed out that LTH supply typically sees sharp declines during the retail-driven phases that accompany cycle peaks. In both cycles, those declines were followed by further price appreciation. So a supply drop by itself wasn't the end, it was just redistribution. For example, after the February 2021 high, Bitcoin corrected about 50% and LTH supply fell, but by November 2021, it hit a new all-time high. In late 2017, Bitcoin dipped 30% after its peak. LTH supply fell, yet it still managed to hit $20,000 that year. The point is, long-term holders selling has often been part of topping process, not the final nail in the coffin. Even this cycle, the pattern is familiar. CoinDesk notes that previous LTH troughs occurred just after new highs, like April 2024, right after a $73,000 peak, and March 2025, during a tariff-driven sell-off. Each time, holders were distributing into strength. This year's LTH selling has been slower and steadier. Instead of a frenzied blow-off top, it's felt like a methodical profit-taking phase. Imagine whales slowly lowering their sell order sails rather than ripping them off in a storm. The takeaway, cycle peaks often see long-term holder supply dip. If you only watch that, you might think it's all over. But history says it could just be a mid-cycle pause. It's when no one is buying that it really gets dangerous. Right now, buyers have stepped in. That changes everything. Data is powerful, but context is king. We must ask, at what price did these long-term holders buy? Glassnode's cost basis metrics help with that. One key measure is the true market mean, the average price of coins last moved on-chain. During the recent dip, this true mean sat near $81,000, and Bitcoin bounced off that level. In plain terms, a lot of active traders' break-even point was about $81,000. That proved to be a flaw. Another big one, US spot Bitcoin ETFs like GBTC, IBIT, etc. Glassnode estimates the average cost basis of all US spot ETF holdings at about $83,844. In other words, roughly half of all ETF buyers are standing or slightly underwater in the low $80,000. These ETFs collectively hold around 1.31 million BTC, approximately $117 billion. As of mid-December, CryptoSlate reports that approximately $100 billion worth of Bitcoin is sitting near the $80,000 to $83,000 break-even range. This means a ton of capital is anchored there. It's a support zone by cost basis alone. All these metrics, the true market mean near $81,000, ETF average cost approximately $83,000, and the 2024 cohort cost basis at approximately $83,000 cluster in the same area. It's no coincidence. Traders call this a confluence zone. It suggests heavy demand under $84,000. Indeed, Bitcoin found support right around those levels, which explains why the $80,000 test held instead of breaking wide open. Meanwhile, funding rates on futures turned slightly negative in late November, which might sound bearish, but such signals often reverse quickly. What matters more? Who is buying on-chain? Interestingly, blockchain data shows whales have been accumulating in this dip. Santiman and CoinGlass notes that whale addresses holding 1,000 plus BTC actually increased in number in December. Some analysis even found whales' 10,000 plus BTC wallets added tens of thousands of BTC in early December, after selling earlier. That's opposite of panic, it's opportunistic accumulation. ETF flows have been mixed, but importantly, they haven't crossed into anything resembling panic. In early December, right as price was probing local lows, we actually saw roughly $100 million flow into BlackRock's IBIT. That timing matters. It suggests that large, methodical players were willing to step in when sentiment was weakest, rather than pulling capital off the table. If institutions were genuinely losing confidence, you'd expect to see sustained aggressive outflows across the board. That simply didn't happen. Yes, there were brief spikes in redemptions during the sharpest drawdowns, and that's not unusual. ETFs tend to react to volatility, especially when short-term participants de-risk. But what's telling is what happened next. As price stabilized and bounced, those outflows slowed and buyers appeared to absorb the supply. In other words, sellers didn't overwhelm the market, they were met by demand. Zooming out, ETFs still collectively hold around 1.312 million BTC. That's an enormous chunk of supply that hasn't disappeared. Redemptions may create headwinds in the short term, but they haven't dismantled the ETF cohort or reversed its broader role in the market. When you line that up with the on-chain data, a consistent story emerges. This market isn't being emptied out, it's being reshuffled. Older coins moved, but they didn't vanish. They landed in new wallets. Several on-chain analyses point to whales accumulating at discounted levels, while smaller retail addresses reduced exposure. That pattern shows up again and again during healthy corrections. It's uncomfortable, but it's also how markets mature. Capital rotates from weaker hands to stronger ones. In plain terms, smart money is buying when fear is loudest. Taking all of this together, instead of seeing only despair in the numbers, it's more productive to notice how cost basis data and flow metrics are stacking up as support. The $80,000 to $84,000 region isn't arbitrary. Multiple cohorts have a vested interest there. From an on-chain perspective, this zone lines up with where buyers historically defend positions. That doesn't guarantee a bottom, but it does explain why price keeps finding bids in that area. Now, from a pure charting standpoint, caution is still warranted. Bitcoin did break below the 50-week moving average, a level that has defined the broader trend for years. That's not something to dismiss lightly. We also saw a bearish flag structure on the weekly chart with a measured move pointing down toward the high $60,000 if support were to fail. Several shorter-term moving averages and trend lines have rolled over, and momentum traders will rightfully flag that as technical damage. There's no reason to sugarcoat it. These signals tell us risk is elevated, but charts don't exist in a vacuum. What really stands out is how price behaved once it reached the $80,000 to $83,000 zone, right where the on-chain cost basis metrics converged. Each dip into that region was met with swift buying. Sellers tried and buyers responded almost immediately. That's not random. It suggests those on-chain supports were actively defended. Late November is a good example. Price bottomed almost perfectly alongside the true market mean and ETF cost basis. Without that demand, we likely would have seen a cascading breakdown. Instead, we saw stabilization and a rebound. Momentum indicators also add context. By late November, weekly RSI and MACD were deeply oversold. Historically, when those indicators reach extremes on the weekly timeframe, it often signals exhaustion rather than continuation. It doesn't mean price has to rip higher immediately, but it does suggest that downside momentum is losing steam. Extremes tend to align with meaningful inflection points more often than not. History supports that idea as well. During the 2020 to 2021 cycle, Bitcoin dipped below the 50-week moving average multiple times. Each break caused fear, and each one eventually resolved with a reclaim and renewed upside. A lost moving average is a warning sign, not a death sentence. Trends can resume if conditions shift. Even recent analysis from investing.com frames the current move as a liquidity reset rather than a structural breakdown. The fundamentals haven't disappeared, they've just been tested. So my takeaway from the charts is this: we have to respect the downside risks. If $84,000 decisively breaks, lower targets absolutely come into play. But we also have to acknowledge the contradiction in the data. The exact levels where technical damage showed up are the same levels where on-chain buyers stepped in aggressively. That overlap matters. It suggests that a lot of selling pressure may have been absorbed right at the seam between price action and fundamental demand. One important caveat: on-chain data is powerful, but it isn't magic. It can surface scary-looking metrics that seem decisive in the moment. A massive red candle or a surge in realized losses can scream "sell" at first glance. But sometimes that's simply the market clearing excess, leverage, and weak conviction. What looks like disaster on paper can end up being the runway for the next move higher. The same goes for metrics like supply shock ratios or network growth. Spikes can look alarming in isolation. Social media amplifies those signals and wraps them in fear. But the data doesn't tell you how many people are calmly accumulating in the background. It only tells you what changed hands. That's why the real question is always the same: who is selling and who is buying? If nervous, short-term participants are exiting while larger, more patient players are accumulating, the narrative flips, and that appears to be what we're seeing. Bitcoin has rotated from older holders into newer, more stable hands. In that context, the data starts to look far more constructive than the headlines suggest. One group's profit-taking becomes another group's opportunity. It may sound counterintuitive, but sharp drawdowns often plant the seeds for the next rally. When long-term holders take profits after large gains, they transfer coins to buyers who are willing and often required to hold through volatility. That strengthens the holder base. We've seen this after nearly every major correction in Bitcoin's history. Pullbacks of 30% to even 50% are uncomfortable, but they're also common before another leg higher, especially in halving adjacent periods. If history even loosely rhymes, being down around 30% from the highs still leaves plenty of room for a recovery. Think of it this way: once the fear has already flushed out, who's actually left to sell? If you bought Bitcoin at $20,000, $30,000, or even $50,000, sitting through $80,000 doesn't feel catastrophic. You're still well in profit, and psychologically, that matters. Those holders are far less likely to panic sell into weakness. Even investors who entered higher, say in the 60,000s or 70,000s, are often thinking in longer timeframes rather than reacting to every dip. Now contrast that with a brand new buyer stepping in around $90,000. If price pulls back, their downside is relatively limited compared to someone who chased much higher levels earlier in the cycle. This mix of cost bases can naturally create a sturdier floor, because fewer participants feel forced to exit at once. On top of that, most of the mechanical selling has likely already occurred. Forced liquidations, blown leverage, and margin calls tend to cluster during sharp moves, not after price stabilizes. Futures traders who were positioned for non-stop upside have largely been flushed out. That kind of squeeze often marks exhaustion on one side of the trade. When leverage is cleared and positioning resets, the market becomes less fragile. Historically, that environment often precedes at least a meaningful bounce, if not a full trend shift. Now zoom out and consider the institutional backdrop, because context really matters here. We're only a few months away from the 2026 halving. Large players don't ignore that calendar. Funds, desks, and long-term allocators tend to reposition well ahead of the actual event, not after it's obvious to everyone. They understand that supply dynamics tighten over time, and that demand often ramps up post-halving. If they see an opportunity to accumulate at discounted levels before that narrative reasserts itself, they're not waiting for perfect headlines. The on-chain data showing whale accumulation fits neatly into that framework. It doesn't look like reckless speculation, it looks deliberate. That brings us to the silver lining. If the $80,000 region continues to hold the way it has, there's a strong case that the worst of the selling pressure is already behind us. Markets rarely move in straight lines, but once a base forms, rebounds can happen faster than most expect. A push back toward $90,000 or higher wouldn't just retrace price, it would also test short positions that piled in late. Even a modest short squeeze could add fuel to a recovery move. On the upside, several analysts point out that reclaiming the mid-$90,000 range could materially shift sentiment. Confidence tends to return quickly once key levels are regained, and momentum traders often follow. None of this is guaranteed, of course, but the risk-reward profile is starting to look asymmetric. Without a clear negative catalyst, another deep freefall becomes harder to justify, while upside moves driven by positioning and sentiment remain plausible. So where does that leave us overall? Yes, long-term holders have reduced some exposure, but the behavior looks far more like disciplined profit-taking than outright panic. Supply appears to be rotating from early holders to new committed buyers. That's a normal process in advancing markets. Technically, there are still reasons for caution. A key moving average has been lost, volatility remains elevated, and chop is always possible. But multiple on-chain cost basis levels clustering between $80,000 and $84,000 suggest this zone is functioning more like a foundation than a trapdoor. This looks less like capitulation and more like a base-building phase where the market decides its next direction. It's completely fair to debate both sides. Some traders will look at the same data and stay bearish, and that's part of what makes a market. That's why I encourage you to do your own work. Pull up the charts yourself. Watch how Bitcoin behaves around these cost basis levels. Pay attention to how institutions and large wallets respond to dips and rallies. Manage your risk carefully with position sizing and stops, and challenge every assumption, including mine. At the end of the day, it's your capital and your conviction. One last thing. If you're newer to reading charts or on-chain data, you don't have to figure it all out alone. Resources like the Cheeky School courses or the free Cheeky Crypto Educational Discord are solid places to learn and talk through these setups with others. We focus on breaking things down calmly, without hype, and helping people understand what the data is actually saying. And just to be clear, I'm not a financial advisor, and nothing in this video is financial advice. Crypto is volatile, you can lose money, and you should always do your own research and consult a qualified professional. Your investments are your responsibility, and nothing in markets is ever guaranteed. This video is for educational and entertainment purposes only. Thanks for sticking with me through this deep dive. I know it was a long one, but I wanted to cover all the angles. If you found it helpful, consider subscribing or watching the next video. Until then, stay curious, manage your risk, and trade safe.